Thank you all for joining and listening to our monthly recap. Today we want to review the first half of the year and look at some of the trends we expected, maybe some of the unexpected things that have happened the first half of the year, then a little bit to look into what's ahead with the earnings season upon us and their second half of the year. With that, Michael, you want to start some of the thoughts on the first half of the year?
Sure. So for the most part, all the indices we saw had positive returns, but those weren't really equal across the board. And when you look at numbers like the S&P 500, it was up, give or take, 15%. But when you look at the equal weighted S&P 500 ETF, it was up 19%. So that's telling us that the breadth of the market was outperforming just those top names. And the question is really from there, is this a trend that's going to continue? Is value going to continue to outperform on the growth side of things? And where do we see the next 6 months going? And one of the biggest questions from that is when you look at June, you saw one of the biggest rotations back to growth from value, where growth outperformed value by about 8%. But that being said, value stocks were still up about 16, 17% first half of the year, and growth stocks were up 13%. So when we look at where we're going with value, another thing to consider is the record amounts of dividends that we think different industries are going to start paying out. And one of those areas there are financials. So Jared, can you talk a little bit about the stress tests that the banks just went through and really what that means?
Yeah, the Federal Reserve put sort of handcuffs on the banks during COVID, expecting a lot like the financial crisis, a lot of mortgage losses, commercial losses and such. And it just didn't happen, or it hasn't happened at this point. So now as we turn the calendar to July, the Fed did their stress tests and are now allowing, with all the banks having passed with flying colors, to return more capital to shareholders. So you've seen record profitability the last number of quarters from the majority of the financials, but they haven't been able to increase dividends and share buybacks for the most part. But they just announced this past week, many of the banks, and a couple increased dividends as much as 100%. So you're going to see a lot more capital returned. And again, the profitability of banks in this environment is strong, and they tend to do well in this inflationary environment. So it's just an area we expected to see, and it's happened, and those dividend payments are coming in the second half of the year.
And along with financials, I feel like commodities are going to be another area that's going to start paying out more cash to shareholders as they historically have. Can you talk about those a little bit too?
Yeah, the one big thing in the month was the Fed talking inflation has been transitory, and now it's not. So with the announcement, they're actually concerned and are seeing the inflationary trends. And we've been talking about this really for the last year. A lot of the underlying commodity stocks with the strength of the housing, I mean, you saw pending home sales, the highest number in a very long time. So there was a shortage of housing. It looks like a lot of inventory is coming back to the market. And we think that'll continue to fuel demand for copper, steel, aluminum, iron ore. And again, these prices are up a lot and the demand is strong. So historically, when you look at this inflationary environment and the housing boom, these companies have record profitability and they tend to increase dividends. You've seen a little bit of that in the first half of the year, but we'd expect, similar to the banks, a lot more capital return to shareholders in the third and fourth quarter.
Yeah, and I think, as you're talking about capital return to shareholders, I think an interesting trend that we're going to see more of is companies really reinvesting themselves and paying the profits back and looking to really build out their sort of internal infrastructure. When you look at a lot of, say, retailers that were able to pivot more to direct to consumer, not as dependent on brick and mortar, and sort of really consolidate their inventory channels, it seems as though these companies are really poised for very strong growth in the years ahead, but they want to sort of build in their internal systems to make sure they can sustain those type of growth. It's essentially digesting everything that's happened over the last year and then really building out for the future.
Yeah, we love to your point, Michael, looking ahead to these companies, because the market tends to be disappointed when you see quarterly earnings, and we think we'll see some of this in July and August, where costs are going to be higher for companies. But if the cost is up because they're investing, that's a great sign. So we're going to look for opportunities like that if companies are down to buy those. Those will be longer term opportunities. The other thing with wages and investing in your people, it's important to invest in talent and such. And some of the companies announce higher costs just to retain and maintain talent because there's a labor shortage we think that trend's going to continue. And you see a lot of this right now with $1,000 bonuses minimum to try to get people to switch over and take jobs and such. So companies have to raise costs to keep the talent ahead, and we'll be looking for that trend this earnings season.
So JR, just kind of recapping again, first half of the year, we've seen 12-15% returns, give or take. Is that something that we can really expect, going the second half of the year? Can we kind of just relax and say, all right, this is going to be, another 20+% year?
We wish it would be that easy to just take it ×2 or halfway through the year. But the reality is that the market returns because of the vaccine, the optimism, the stimulus and such. That was kind of our expectation, that the majority of the return would be the first half of the year. So we're mindful that there are going to be changes ahead, but it's unlikely that we'll see this type of performance the second half of the year. We think it's going to be more selective performance throughout the markets, and rotating within it is our expectations. So with that, we want to thank everyone for listening and hope you have a great 4th of July.
All right. Thank you, everybody.